All right, let's apply some of what we're learning in Chapter 1 to some example problems. Over here on the left, I have the problems, and over on the right side of the screen will be the solutions that we will walk through. So let's start with exercise 1-11. We're going to be determining the effect of transactions on the accounting equation. So we are going to be answering these questions, and each of these questions is independent of one another. So remember the basic accounting equation: assets equal liabilities plus equity. On January 1st, Lumia Company's liabilities are $60,000 and its equity is $40,000. On January 3rd, they purchase and install solar panel assets that cost them $10,000. When they purchased those panels, they paid $4,000 in cash, along with a promise to pay the remaining $6,000 in 6 months. What is the total of Lumia's assets after the solar panel purchase? So in order to figure this out, we need to figure out, starting, what the beginning of the year accounting equation was. So at the beginning of the year, we know that assets, or we don't know what assets were. They told us the amount of liabilities and the amount of equity. Knowing that this basic accounting equation has to balance, the only way it balances is if beginning assets were $100,000. So we know they started the year with $100,000. When they purchased the panels, the solar panels, they purchased an asset. That asset would have caused their assets to go up. Okay, so they're going to be increasing their assets. At the same time, their cash will go down. So they started the year with $100,000 in assets, but then when they purchased the panels, their assets increased, and at the same time, their assets also decreased because they paid $4,000 in cash. So assets increased 10 and decreased 4. So we know that assets at the end of the year must have been $106,000. The other way to do it is to look at what happened to our liabilities. Again, we don't know what assets were at the beginning of the, on January 3rd, but we know that there's $60,000 in liabilities that they started with increased $6,000. So their liabilities increased to $66,000. Equity was unchanged by this transaction because only assets and liabilities were affected. So the equity stayed the same. That means that in order for this equation to balance, assets must have been $106,000 at the end of the year. Okay. B, completely independent, different company, not related to Part A. On March 1st, the company's assets are $100,000 and liabilities are $30,000. So right away we know if assets were $100,000, liabilities were $30,000, their equity at the beginning of March must have been $70,000. On March 5th, the company was fined $15,000 for failing emission standards, and they immediately paid that fine in cash. A fine to a company is an expense. So that means they have more expenses, their expenses are going up, and their cash went down because they spent cash. So I can go back to my basic equation. Assets would have gone down $15,000 for the expense of the fine that they paid, bringing their assets down to $85,000. Liabilities were unaffected. They don't owe anything, they paid the fine. So then the question becomes, well, what happened to equity? Well, as the company incurred a new expense, their equity went down. So I know that their equity on March 1st was $70,000. The $15,000 fine would have increased expenses and decreased their equity to $55,000. The other way to look at it is knowing that assets went down to $85,000, liabilities were unchanged, equity must have ended at $55,000. Again, the concept here is when one item in the accounting equation changes, something else needs to change as well, right? Because we always have two things affected. All right, Part C. On August 1st, Lola Company's assets are $30,000. Its liabilities are $10,000. 3 days later, they issued a sustainability report. On August 5th, the day after, they got a bunch of new owners. Ownership invests another $3,000 in cash into the company, along with $7,000 of equipment. They're asking after the investment, what is the amount of equity for Lola? Well, let's start with what did they have in equity before the additional owner investment. Assets were 30, liabilities were 10, beginning equity must have been $20,000. When the owners invest another $10,000, it caused their assets to go up. Liabilities remained unaffected by the owner investment. Assets on the 5th were 40. Liabilities were $10,000. That means equity must have been $30,000. Okay. Again, using that basic accounting equation, it must always stay in balance. So if something is affecting it, it's going to affect at least two things. All right, now that we have reminded ourselves or worked with that basic accounting equation, let's apply it to some more transactions. We are going to work with Gabby Graham, who is starting the Graham Company. It's a new business. It's beginning operations on the 1st of May. The Graham Company completed the following transactions during this first month of operations in May. What we're going to be doing in this problem is we are going to create a table so that we can see how the transactions are affecting the company's accounting equation and how these transactions affected the company financially. Okay, so we're going to set up a table that looks something like this. Okay, we're going to have our assets equal our liabilities plus our equity. Within our assets, we are going to be tracking each type of asset separately from one another. We would have multiple liabilities. Normally, this problem, we only have one liability account. We also have within equity the different accounts affecting equity. Okay. So I'm going to go ahead and pull this up. Okay. One thing I want to point out is what we're seeing here is just a way to analyze the transactions. This is not part of the formal accounting system. You will not see this format again after this chapter. Okay, it's just a way to visualize the impact of the transactions on the company's accounting equation. Right. So I'm going to make this a little bit bigger in hopes that it'll be a little bit easier to see. All right, the very first transaction that occurred on the 1st of May is Graham invested $40,000 cash in the company. Graham is the owner. When the owner invests into the company is receiving $40,000 in cash, so the company's cash will increase. So on our transaction analysis on the 1st of May, we are showing the company's cash increase 40. And when the owner invested, the owner's capital account increases as well. Total assets go up 40, total liabilities and equity go up 40. Our equation is in balance. That same day, the company rented a furnished office and paid $2,200 cash for the month's rent. If the company paid cash, the company's cash is decreasing and they are paying rent. Rent is an expense. It is a cost of operating. So seeing the effect of this transaction on the accounting equation, we need to decrease our cash and expenses will go up. Now this minus sign here is misleading because this looks like we are subtracting expenses for rent. We are not subtracting expenses. This minus sign means the increase to the expense is causing overall equity to go down. May 3rd, the company purchased $1,890 of equipment on credit. The company is buying equipment. Equipment is an asset. They have more asset, more equipment. They bought it on credit, which means they haven't paid, so their liabilities are going to go up. So seeing the impact of this transaction, in the next chapter we're going to learn how we record this in the accounting system. For now, we are just looking at What needs to be changed? The equipment account needs to be increased because the company has more equipment, and the liabilities, accounts payable, needs to increase as well because the company has more liabilities. Assets go up, liabilities go up, keeping our equation in balance. On May 5th, the company paid $750 in cash for the month's cleaning services. How is this affecting the company financially? Well, the company's cash is going to decrease because they paid an expense. A cleaning service is a cost of operating. Cash needs to be decreased and expenses need to be increased. They have more expenses. So cash will go down and our expenses will go up. Again, we are increasing the expenses. The more the expenses go up, the more they cause overall equity to go down. On the 8th, the company provided consulting services for a client and immediately collected $5,400 in cash. When the company provided the services to the client, they have earned the revenue. We need to increase our revenues. They have made a sale. Additionally, they received $5,400 in cash. So cash needs to be increased and revenues need to be increased as well. This plus sign means the more revenues we record, the more overall equity increases. So assets go up, equity goes up, $5,400. On May 12th, the company provided $2,500 of consulting services for a client on credit. Again, the company provided the service, they have earned the revenue. We record revenues at the time they are earned. Even though the client didn't pay, the client owes the company for the services they were provided. Revenues need to increase. The company has earned revenues, and the amount owed to the company, the account receivable, has also increased. So on the 12th, the assets, accounts receivable, increased $2,500 and revenues increased $2,500. Notice that in both of these transactions, revenue was recorded at the time it was earned. Even though we didn't receive payment for it, accrual accounting says record revenues when they are earned. We don't need to wait for cash to be received to record it. Okay. On the 15th, the company paid $750 cash for an assistant's salary for the first half of the month. Paid cash. Cash needs to be decreased, and the assistant's salary, salaries and wages, that is an expense to the company. So cash will decrease $750 and expenses will increase $750 for the salaries. Expenses are going up. The more the expenses increase, the more they cause overall equity to go down. On the 20th, the company received $2,500 cash payment for the services provided on May 12th. Remember, back here on the 12th, we recorded the revenue when we provided the service to the client, but the client hadn't paid us at that time, so we recorded an increase to our receivable. Now on the 20th, the company is receiving that payment from the client. So cash needs to be increased, and we're not providing new services to the client. The client is paying us for prior services, which means they no longer owe the $2,500 account receivable. Our accounts receivable need to be decreased. On the 22nd, the company provided $3,200 of consulting services on credit. Again, we record revenues at the time they are earned. We have provided the service to the client. We have earned the revenue. We're not paid for the revenue yet, So we have more accounts receivable. Our accounts receivable is increasing. Revenues are going to increase $3,200 and accounts receivable increase $3,200. More revenues are recorded. The more the revenues increase, the more they cause equity to increase. Receivables are now increased as well. Our equation is staying in balance because every time we increase something on this side of the equation, we are affecting something else. Either something on this side of the equation decreases at the same time, or something on this side of the equation increases at the same time. 3 days later, after we made that sale on credit, the company received $3,200 cash payment for the services it had provided a couple days earlier. When they provided the service, we recorded the revenue. On the 25th, we are not earning more revenues, we are simply receiving a payment for prior services provided. We are receiving payment for the amount owed to the company. Cash needs to be increased and accounts receivable needs to be decreased. We are no longer owed that $3,200 from the customer. On the 26th, the company paid $1,890 cash for the equipment purchased on the 3rd of May. Oh my gosh, way back here on the 3rd of May, we bought equipment. Our assets increased at the time and we didn't pay for that purchase, so our liabilities went up as well. Now, 26th, we are now making payment for that purchase. We are not buying more equipment, we are paying off our liability. So this is simply cash decreasing, liabilities decreasing as well. Cash will be decreased and the liability will be decreased. Assets go down, liabilities and equity go down. On the 27th, the company purchased $80 of equipment on credit, bought more asset on credit. Assets, equipment needs to increase, liabilities need to increase as well. Equipment needs to be increased 80 and accounts payable needs to be increased 80. On the 28th, the company paid $750 cash for an assistant's salary for the second half of this month. Again, the company's cash was used. It needs to decrease because they spent cash and they spent it on the assistant's salary. Second payday of the month, salaries and wages are an expense to the company, so we are going to increase our expenses. Decrease cash $750, add to our expenses, increasing our expenses. Okay. More the expenses increase, the more they are causing overall equity to go down. On the 30th, the company paid $300 cash for this month's telephone bill. We're going to look at this one at the same time we do the next one because they're both very similar. In the next one, the company paid $280 cash for the month's utilities. Telephone and utilities, both of these are expenses to the company. They spent cash to pay these expenses, so cash needs to be decreased. And their expenses need to be increased for their telephone bill expense and their utility expense. So in both of these, we're going to see a decrease to cash, and we're going to see increasing our expenses, adding to our expenses. The more we add to our expenses, the bigger they become, the more they cause overall equity to go down. Finally, on the 31st, the owner withdrew $1,400 cash from the company for their personal use. We are needing to decrease cash because the owner took the money out of the company. Cash is going down. The owner withdrew. The owner is taking some of their equity out of the business so that they can use it for their personal funds. Cash will need to be decreased, and the owner withdrawals is increasing. We have more owner withdrawals. Just like with expenses, the more the owner withdraws, the bigger this number becomes, the more it causes overall equity to go down. All right, what we have done is we have gone through the month of May, and we have analyzed to determine everything that affected the company financially. In the next chapter, we're going to learn how we enter this in the accounting system. For now, we are just visualizing the impact. So now the owner says, okay, this is fantastic. I'm glad that you've been keeping track of the company over the month. I want to know how we're doing. Well, we can tell the owner everything is documented here. Just go look at this. But this isn't very informative. So what we end up doing is we prepare financial statements to communicate how the company did for the month. So we are going to prepare the income statement, the statement of owner's equity, and the balance sheet as of May 31st. So we are communicating how the company did financially for the month of May. The first financial report is the income statement. It is only going to report the profitability of the company, the difference between the revenues earned or the sales made and the expenses incurred to earn those sales. Total revenues earned during the month were 11,100, and here we've been keeping track of the different types of expenses. They were 5,030. So preparing our income statement. Every financial report has a 3-line heading. First line is the name of the company. Second line is which financial statement it is, and the third line is the date of the report. The income statement is reporting the revenues earned and expenses incurred for a period of time, for the whole month of May. The revenues that we had recorded were 11,100, and the total expenses were 5,030. To make it more informative, we are going to list each type of expense individually of one another, right? Because we could list just total expenses, but the readers of the financial reports want to know details of what makes up the company's expenses. Okay, so if we subtract the total expenses from the revenues earned, we have a net income of 6,070. Because the revenues exceeded the expenses, it is an income. If the expenses had been greater than the revenues, it would have been a net loss. Okay. Notice that they have a section heading in the financial statement. This is a section title telling us what is going to be reported after it. Okay. And they use a separate column here just to kind of differentiate what numbers are being added, because this single line here is a subtotal. That's telling you that the number right below this line is a combination of all the numbers right above that line. Okay. So here is our subtotal in this column. This number right below that single line is a summary of the numbers above it. Revenues minus total expenses. All right, so we have now communicated to the owner the profitability of the company during the month of May. The owner says, that's fantastic. I want to know how that affected my equity in the company. The owner's equity is made up of the owner's capital, withdrawals, revenues, and expenses. So the statement of owner's equity is going to report a little bit more detail how the company, how the owner's equity was affected during the month of May. So again, 3 lines in the heading, company name, which report this is the statement of owner's equity, and the date. We are reporting the change in owner's equity from the beginning of May to the end of May. This was a brand new company. which means at the beginning of May, there was no owner equity. It was zero. Nothing had been recorded in the accounting system. The things that increased owner's capital during the month, owner investments. So going back up here, I can see that the owner invested $40,000. That's the balance in the owner's capital account. Nothing else affected owner's capital during the month. So the owner investment increased owner's capital. The other thing that affected owner's capital were the profits, the difference between the revenues and expenses. Instead of re-reporting the profitability, we are going to use the net income that we've already reported from the income statement. So the income statement is prepared first because net income is used to prepare our statement of owner's equity. The owner's capital increased by investments, increased by income. We have a subtotal here. What would have caused equity to go down? Well, the owner withdrew $1,400 during the month. So owner's equity was decreased by the amount of withdrawals. That means that the value of the owner's equity by the end of May, $44,670. Increased by investments, increased by profits, decreased by owner withdrawals. All right, so the owner's super happy. The owner's equity increased up to $44,670. The value of the company, the owner, has gone up quite a bit during the month. The company was profitable. Now the owner says, how is the company positioned financially overall? And that's what the balance sheet is going to report. It is going to take all assets, all liabilities, and the ending owner's equity, ending owner's capital. So here on my balance sheet, again, 3-line heading, company name. This is the balance sheet financial report and the date. Take a look at that date. That's different from the other two reports. The other two reports were reporting what happened over a period of time throughout the month of May, profits throughout the month of May, changes to equity throughout the month of May. But the balance sheet is reporting a snapshot, a screenshot on one day in time. These are the assets on May 31st, the last day of this accounting period. Total cash, total equipment, total assets. The liabilities, total liabilities of 80. And instead of re-reporting all of these elements of equity, we are going to use the ending owner's capital from our statement of owner's equity to prepare the balance sheet. We've already summarized what owner's equity ended May with. Instead of re-reporting all of those changes in the equity, we are just reporting the ending amount. Total assets were $44,750. Total liabilities and equity $44,750 on May 31st. Okay. Notice that we did these financial reports in a specific order. Income statement first because we needed net income from the income statement to prepare the statement of owner's equity. Then we prepared statement of owner's equity second because we need ending owner's capital to prepare the balance sheet. Okay. So the financial statements are kind of feeding each other information. Okay. Now there is one more financial report that exists, and I'm just going to show you it for now, but we're going to learn more about this financial report much later in the course because there's a lot of things I need to teach you before you can completely understand this financial report. Okay. And the statement of owner's the statement of cash flows is going to report where did the company's cash come from during this month and where was it spent. Okay, so if we go up here and look at our cash column, we ended the month with $42,780 in cash, but there was a lot of things that happened during the month that affected it. And the owner just kind of wants to know, where is all our cash coming from? Is it mostly from my investment, or is the company generating cash from operations? Okay, so that's what the statement of cash flow reports. It breaks down cash flows for the period of the month. Again, it's a period of time, just like the income statement and statement of owner's equity. And it shows where cash came from operating activities, investing activities, and financing activities. Okay, so it's kind of reporting what was generating the cash for the company. Okay. And so again, we're going to spend a whole chapter talking about this report. I just want to show you because I want you to know it exists. It is one of the 4 primary financial reports. And ultimately what it does is it explains the change in cash, right? It shows overall, did cash go up or down? Where did that cash come from, or where was it spent? Okay. And then it kind of reconciles the beginning cash balance with the ending cash balance. So it's really explaining where does the company's cash come from and where is it spent. So it just provides more detail. Okay. All right, hopefully that helps with your understanding of these concepts, seeing it applied to these problems. And now it's time to go do your homework assignment.